Okay, welcome to the channel. I think we are live. We are live now. I just saw someone post a link trade on in the Discord group, but this is a bearish divergence here on the 4 hourly. So I think the name of the guy is Frost. Yeah, it could go up anyway. But the bearish, I don't like longing anything when the 4 hourly is bearish. I don't like that. It just turn on you at any point. Is everyone there? How many people are there? Who is there? Who is not? Let's see who is live. Who is here with us? All right, we have 6 people. Hello, Bada. Who's the other one? Oh, Christian Kovas. Yeah, you're always here. I think the Bulgarian guy. All right, so we'll be beginning very soon. Yeah. Let's see. I think we could make this every Sunday. Sunday is preferable, yeah? A lot of people are free on Sunday. No school, no. Some people would go to church, but I think Sunday is better. So, yeah, I was just looking at this. I saw someone post in the group that link has a bull flag. I'm gonna put this. Okay. Bull flag. If you take this from here to here, 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 you have your double bottom. Double bottom will be here, and then like so. Now it's going to be a bit difficult to explain patterns because, as I said before, it's really just it's more subjective than objective, so you will have to see it yourself. Okay, so that will be the falling wedge. This here. This will be the target for the double bottom from here to here. And voila, we have it. So yeah, so we have it here. That's the target for the double bottom. So you could be like, how did I know that this will be the target? Same thing I was saying. And this may as well be the target. This down here. Yeah. But I would take this one. I would take this one because it's the target for both. Is the target for the double bottom. That's the yellow. You see the 1, 2, 3, 4. That's the double bottom. So it's the target for this and this, which is the double bottom, and it's also the target for the falling wedge. So the widest part of the wedge is the target. So since it's the target for 2, you take that target, not the target for 1. Anyway, we'll explain all of this as we go further. And I'm gonna put this thing on widescreen. I don't know why it was here. I think I have a separate. Okay. Yeah, so we have a blank screen here. How many people are here? 8 people watching. All right, cool. Okay, so let's begin. Now, so as I was saying in the other video, I hope you guys can hear me and everything is smooth. As I was saying in the other video, hello, Koala, hello, Mick Puda. Yeah, as I was saying in the other video, we were talking about candlesticks. In the other video, we're talking more about price action, not names of candlesticks. It's important to understand what is actually happening in the various candles than knowing their names. You can read up their names anywhere. I mean, I could give you a screenshot of something and you just basically memorize the names. What's more important is knowing what actually happens when you see a candlestick, what is actually going on when you see any candlestick. So that's what is actually important, because that will make you understand what could potentially happen later. As I said before, all we are trying to do is know what could potentially happen, not what will happen. So there is no guarantee of a future outcome. I mean, life is in itself is uncertain, so you cannot know. Now, what you have to understand is every given candlestick, like this right here, is a weekly chart. So on every chart that you see, be it on the daily, weekly, monthly, hourly, 4-hourly, what you are basically observing is what is going on during that time frame. So each of these candles, when I say represents a week's worth of price action, it basically means that each candle here represents the price action that happened in a week. So that's what we are seeing here. If we go to the monthly, it's price action for a month. So if you notice that we were just dumping in an entire month, that monthly candle will be red. And if we say pump in an entire month, that monthly candle will be green. Now the colors don't really matter because you can change them, but it's, you know, mostly like this on every platform. This is like the default color because that's what we are accustomed to. Hello, welcome. Yeah, so these candles, when we combine them with other candle, like each candle, when we combine with another candle, it can let us have, say, a glimpse of what could happen in the next month. In the other video, we mentioned bullish engulfings and bearish engulfings. These are like the that's what you mostly see here. Yeah, so we have a bearish engulfing here. As I said, the names themselves do not really matter. When you understand what's going on in each candle, you can predict what could potentially happen. And I will give you a pro tip here. What could potentially happen in the next month, because we are on the monthly time frame. Now, as you go into higher time frames, the possibility of say an outcome, of a future outcome, increases. So your degree of certainty increases with increase in time frame. If you see a bullish engulfing, or say you see a bearish engulfing like this one on a monthly time frame, it has a higher effect than a bearish engulfing on an hourly time frame. So with increase in time frame, your degree of certainty increases. What you think might happen actually increases. This is why I do make some predictions and they end up happening. It's not because I'm so smart or I am, you know, the boss of this. No, it's simply because I read higher time frames more. So what I say has a very high degree or say high certainty of happening. We see a bearish engulfing pattern here. Now, this simply means, as I was saying in my other video, is that we had, a bullish engulfing here, the green candle engulfing the red candle before it, which means we had this here, which I was talking about in my in the other video. We had this doji here, which I said simply means indecision. The markets don't really know if we should be going up or down. Now let's really start from here, explain exactly what is going on until here. This is the total market cap for altcoins. Yes, crypto total market cap for altcoins. Let's go to Bitcoin. No, let's stay here on altcoins, the same thing. Now, these all of this happens on this is, you can use this on any market, okay? If you could actually have a chart of your life, perhaps you could predict what will happen in your life maybe tomorrow or next month. So let's start from here. So here we had this kind of a doji or something, but it's basically indecision. Yeah, indecision, but mostly bearish. So we have the market consolidating throughout this. We had some violent push to the upside at the start of the candle. Let's enlarge that so that you can see it more clearly. Okay, so we had a violent push to the upside. How do I know that it was first to the upside, you might ask? The candle started here. Yes, I hope you can see that. The candle started here. So this was the open of that month. This was the first day of that month. So we are on the monthly. Everything we see here will be on days. We will calculate them on days, not on minutes, because a minute will be so tiny on this time frame. So we had a violent push throughout the first days of this month up to here. Now the remainder maybe say from the 8th, I'm just guessing here just so that it makes sense, from the 8th of that month. This was July of 2017. From the 8th of July 2017, the price dumped right down to here, to about 10 billion. Yeah. Let's say this happened to about, say, the 25th of that month, and then came back up here. So came back up here means people were buying and the price was increasing up to here. Now on the daily time frames, you will see this, you may not notice this as a consolidation, but when you zoom out to the monthly time frame, you see it more as a consolidation, but the sellers are winning. Now, when we went into August of the next month, as I said before, this method of reading charts is extremely helpful for swing traders, position traders, and investors. If you want to do scalping, this may not really be the type of the angle, but it's necessary to build a foundation, for your trading. It's very necessary to at least understand what's going on, because on any market, forex, stocks, any market that you have charts, you will need to understand this first before you even go to developing a strategy. You will have to start from here. I mean, you cannot go and start trading without even understanding, say, market concept and all of this. You must understand this. So to the next month of August, we had price first come down here, and then we rushed up to here. Now this is extremely bullish, because in the previous month, the buyers and sellers, traders, they did not really know what they were doing. That's simply what this candle is trying to tell us, that in this previous month, the buyers and sellers, they were simply just consolidating around one area. We had a sharp push to the upside, sharp push to the downside, and we came back here and consolidated for quite some time, because this is on the monthly time frame. Now in the next month, we came down a bit here and rushed up, and it was just bullish, which means if you bought anywhere here, you would have made profits. Bought anywhere here, you would have made profits. Anywhere on this time frame, you would have made profits, except from here, because this is right at the top. Now in the next month, it pumped right, it started from here, went up here, which is slightly above the previous high of this month, and then it dumped right down to here. So the only people who stayed in profit were those that bought here. Yeah, so this is simply market psychology that we're dealing with here. A lot of people panicked, and some may have sold to because of fear. Now this cancels out the bullish engulfing candlestick pattern that we have here, because this green candle engulfing this red candle, the red candle before it, is giving strong bullish momentum. Yeah, strong bullish momentum, saying that we are going to continue going to the upside. But here we dumped, and then we formed a hanging man pattern here. Now again, I don't really like going into the names, but it's more it's better to understand exactly. Hello, yeah, hello, people are joining. It's better to understand exactly what's going on rather than understanding, just memorizing the names. The names don't matter. It just matters so that I can say, oh, there is a bullish engulfing pattern, or there is a hanging man, or there is a bearish pin bar pattern somewhere, and you would understand what I am looking out for. Maybe I'll give you a sheet of all these candlestick patterns and their names later, but for now it's better to understand exactly what's going on in the candlesticks themselves. So here we had this hanging man, and this is cancelling out the bullish engulfing candlestick pattern here. On the smaller time frames, like on the weekly or on the daily, you can go in and actually know if this actually cancels that out. Are we actually going to stop going up and instead plummet right down to here? Now coming to the next candle, we have again consolidation, indecision, but a bit more to the downside. So we have people speculating that we will go more to the downside, but they are not so sure. That's what this type of candlestick tells us. But then we have another bullish pattern. You have another bullish candlestick showing more upside potential. Right here, you could know that the next one must be bullish because you understand what's been going on in the previous candles here. But this will mean that you had to wait for 4 months before you could decide to buy on this one right here. And so this one will even be say the 6th month, because this is the 5th, because it's from here that you are drawing your conclusion. It means you have to wait for 5 months before actually buying here, and you have no guarantee if the next month, or say the 7th month, will be bullish. So those are the risks involved with trading or even investing. Investing simply means you are buying now to maybe sell in 5 years or 10 years, but it's the same kind of thing. You hope to sell, finally you hope to sell one day, except you are buying, which is why I mostly talk about utility coins, because you are buying to not really to sell. Your main goal is really not to sell, but to use the coins. It is like buying Ethereum now because you want to be able to use it to perhaps buy NFTs in 2025. You know that Ethereum coin will be much more expensive in 2025 or in 2030, so you want to buy now so that you can use the ETH in 2030 or in 2050. That's investing, because you know that the value of what you are buying will increase, so you prefer to buy it now because buying it then will be too expensive. So that's your strategy around buying now. So that's exactly what is going on here. But now we went up to this candle and we had another candle close here showing bearish price action, and from then we have been plummeting ever since. Now, when you have a bullish or bearish engulfing candle, there is one thing you have to wait for: a confirmation of that candle. Now, confirmation of that candle has to be another bearish candlestick. Okay, what do I mean by that? If you have a bearish engulfing like this one, the one we are looking at, and the next candle is bullish, know that you cannot trade solely based on your idea of a bearish engulfing candle, which means you cannot be shorting or longing because you saw a bearish or bullish engulfing candlestick pattern respectively. You must find a confirmation of that candlestick. So the confirmation should be another bearish engulfing candle like this one. Now, how do we know that this is the confirmation for this pattern here? Because this most certainly was not a confirmation of this bearish engulfing candlestick. Okay, why was it not? What's the difference between this one and this one? So we are looking at the bodies. How much selling pressure is here compared to this one? We have more selling pressure here compared to this one. Why? Because this is mostly consolidation, but because you see that the body of this candle is really thin, meaning that the consolidation, the indecision was really high. Majority of the market did not know if they should be selling or buying. They could not speculate more on future price action. So this could not confirm this downtrending signal here. But here, more of the market were bearish. So the body of this candle is larger than this one, and this candle is after a bearish engulfing pattern. This one is also after a bearish engulfing pattern, but the body of this one is larger than this one. Now, pro tip: the wick of this candlestick pattern here needs to be filled. By filled, I made a video about this sometime here on YouTube about filling the candles. So we see this wick right here, yes, and you also see this wick right here. A proper confirmation will be that the body of the candle following a bearish engulfing pattern should fill the wick of the previous bearish candle. This wick right here, I hope everyone is following up. This wick right here, we have a long wick to the downside here. We have a shorter wick here. But this candle has a very small body, so it does not really fill this wick here. But this candle here, you would see that it has a larger body, so it does not fill it completely, but it fills more than half or more than 70% of this wick right here. So this is a proper confirmation for more downside. Now, this candle on itself also has a larger body, a bearish candle following it, filling its wick completely. This is further confirmation for a price reversal. So even after this one, we have a bullish candle. I would be selling in this bullish candle because I see 3 straight red candles, each complementing each other. It's like this one is telling this one, don't worry, I got you. This one telling this one that don't worry, I got you more than you got this guy. So even if this one is bullish, I would be selling here. Why? Because these 3 are telling me that we are going to the downside here. Okay, so some of the times, or even most of the times, you would find a candle that looks like so, and you would say, oh, that's a bullish engulfing candle. Yeah, that's a bullish engulfing candle. Like this too, price is going to go up. Which is why I tell you that there is manipulation in these markets. Some people will simply buy and buy and buy and buy just to make you also buy. But you're buying from them. That's the difference. You're buying from them, so they already start to sell as you buy. It's the same thing with the Stratos price increase. It went up to about $1. It's a micro cap. It's got about how much? I think like 5 million. 5 million. The market cap of it is like $5 million. So let's see. The market cap of Stratos. Oh, so it's down to 73 cents now. Now, this is something that I really want you guys to understand. I really need you to understand. I really need you to understand this before you go missing out and losing your money. I talked about some crazy coin which I made a video about on the TikTok, and a lot of people just want to buy it. You shouldn't easily be convinced by a guy on TikTok telling you that he's going to buy something. Don't just say, oh, it's just $10 and then you go to invest in it. No. It's just $10, but if the market cap of that coin is say $50,000, and say people buy up the coin to double that market cap, the coin will double in price. It means that the same guy who talked about it, which is me in this case, let's say I was buying the coin for $1,000. Everyone rushed with $10 each to buy, and the price of the coin doubles. I could sell, make 2 times my money, and you all lost. You lose all your money. Yeah, it's just $10, but if I do that, just say 5 times, you would have lost $50. So be very careful out there when you see anybody talking about some random coin. Of course, I know you trust me, but you really have to be careful. There are some people who I think there's a guy on my Insta. He wanted to send me what was that, $11,000 because he had a problem with PayPal, and so he wanted that he sends me $11,000, and I find a way to send him stable coins. I could do that, and I will not cheat him. I cannot cheat anybody, even by a single dollar. Yeah, that's really that's my own nature. I really cannot. Even $1 million cannot convince, nothing, no amount of money can convince me to cheat anyone. Literally no amount of money. Not necessarily because I am good or anything, but because I know I will still get it. There is no amount of money that I think I cannot have. I think I can get anything that I put my mind to it. So there is no need to cheat anyone. It will be more fun if we all get there. If you get there alone, it really will not make any sense. There is no joy in being happy alone. So just be careful when you hear anyone talking about go buy this coin, go do this, go. And I really have an idea that I'm developing, and I think it'll be great. But anyway, we'll talk about that in another video. So the market cap of Stratos is $14 million. All right. If Stratos goes to $28 million, that's a 2x. Not necessarily, actually. But just say the market cap goes to $28 million. That's a 2x on your investment. Now, if one guy brings, say, $14 million, another $14 million, which most of these people can, and buys Stos's price immediately will double. Okay, that will gain a lot of attention. When that happens, you will be like, oh, perhaps I missed out. You'll take your $1,000 10,000 or say your life's worth and put it all in Stratos, because you see that it's going up and you may have missed out. You may never get it at this price. So we're at 28 million. All right. Now, if Stows goes to, who is this now? How many people are here now? Oh, hi. All right. So if Stows goes to, say, $56 million, that will be 2x from the guy who bought $14 million worth of Stows when it was at 14 million. That guy can cash out his 14 million at that point, and all of you who bought when it was at 28 million are wrecked. Okay, yeah, you all are wrecked. He can then sell all of his coins at a 2x and you are all wrecked. So that's how price action happens. That's what we are seeing here on this candle. That's what we are seeing here. We had a lot of confirmation that price is going to go to the downside. But because whales are smart, they know what's going to happen, they study this all the time, they jump in and try to push the price as high as they can, so that the average, or say the retail investor, also comes in and try to buy, in fear of missing on the coming rally, because they see a bullish engulfing here. They don't look at what was the other candles saying. They just jump right in because they see this one and they're like, oh God, if I do not buy now, I may have missed out. At the start of this month, the price does start to go up. Yes? But then the whales who bought here, remember that this price closed down here, yeah? Because this is the open, it went up, came right down here, and came back up a bit, closed here. This body, this huge body after these weeks, tell you not only that this one is further confirming the bearish engulfing that we have here, but it is telling you that this is a huge indication for price downside. This is confirming price going to the downside. But then these whales, they see this. They've been here since here. They know the markets. They jump in, they put in more money, because some of them may have bought here. Yes? But they want to at least get as much money back as they can. So they put in more money, make the markets go up. Now, the charts are telling you this beforehand, that that's what they may do. So instead of you buying, you should be selling with them. In fact, you should sell to them, because as they buy, someone is selling. You should be that smart guy. You should be the one selling here. Yes? You sell to them, and then the dump now on the real retail investors who have no idea what has been going on in the previous candles. So that's what is actually happening here. Then you have the price rush to the downside, coming back to the previous zone where there was indecision. Okay? Now, all of this can be summed up into a pattern. All right, that's where patterns come in. All of this price action can be summed up into a pattern to tell you what could potentially happen in the far future. So all of this that we see here can be summed up into this. Now we are on the monthly, remember? Now can be summed up into this. All of this can be summed up into this. If we take this right here, from here to here, I think it should be, no, it should be from here. Do we see what's going on here? This is a descending triangle. A descending triangle indicates that price will most likely go to the downside. It gives you a bearish bias. An ascending triangle gives you a bullish bias. It tells you that price will go to the upside. As I said, on higher time frames, you get a glimpse of what is to come in the future with a higher degree of certainty and accuracy. On lower time frames, you may have a lot of problems because price will fluctuate. This same type of thing where I talk about whales pushing the price to the upside and selling, they may not do that, or they may do it more with a lot of volatility. So in the very lower time frames, patterns may not be the best, like the 1 minute, the 2, the 5 minute, the 3 minute. Patterns may not really work there because a single dollar could spark up everything. So you need a higher time frame to obey your patterns well, and mostly you would want that from the 1 hourly, 4 hourly, 6 hourly, 8 hourly, 12 hourly, daily time frame, a 3-day time frame, weekly time frame, and monthly time frame. Now maybe in the future we can do this on the yearly time frame, on the 6-month time frame. But in the stock market, you can use the S&P, for example, you can use patterns on the monthly time frame. But it will take just a very long time, but you use that for investing, of course. Now, so that's exactly what we are seeing here. So we see that a descending triangle has the bias for pushing price to the downside. An ascending triangle, if I was to invert this chart, you will see it like so. So this is the normal chart, this is the inverted chart. You would see it like so. This will be an ascending triangle. Price comes up here, hits a resistance, come back down here, hit a support, comes back up here, hit the resistance. This is the upsloping trend line. This is just the regular trend line. But when price breaks through that trend line, you have the price going to meet the target of the ascending triangle. The same thing to the downside. Price comes down here, hits the support, goes back up, hits the resistance, come back down here for support. As it breaks down the support, you have it going to for the price target of the descending triangle. Now, where is the target of the triangle? The widest part of the triangle. That's the target of the triangle. You see it happening perfectly. Now, in many charts, you may have a bit of a problem calculating or measuring where the target of the triangle is. So, for instance, here, you don't know if you should be drawing the line from here to here or from here to here. So, where you would want to look for that is where price touches both closes of the candles in the widest side. So you have the widest side here. So price is closing up here in the triangle and also closing down here. So you want to take it from here to here if you want to be more accurate with your target. You can just take it down up from here to here, it's no problem. But you can take from here to here if you want to be accurate, like extremely accurate, you want to take it from here to here, because in some candlesticks you may not really know if this will be correct. We'll see an example of that hopefully. So we see that price left from here to down here, we have it hitting this close here and also hitting this close here. So if you take that and you put it where price broke to the downside here, where price broke to the downside. So this is the downside of that triangle. Where price broke to the downside, that's where you put your measurement. And then from there, so from here, where price closed below this triangle, you could say that it will come down here. Okay, so now for price to come there, of course there must be some real world events and stuff that will let you understand that price is going down there, and there will be a lot of people telling you that, oh, this happened, this caused it. So how did you know that price is going to come here? That's why I say there are a lot of mysteries in this whole game. I think everything is made up. Everything that we see in our world is made up. If that were not the case, then this would not be possible. You cannot predict with this type of certainty that something would happen, and it does happen because you took some measurements on a chart. So it's either this is sorcery or our world is just a trick, a huge trick. All right. Now, so that is how you measure this. Now, there are basically two types of patterns. You have price continuation patterns and you have price reversal patterns. Price continuation patterns can be bull and bear flags. Even bull and bear flags are our best examples for price continuation patterns. So what is an example of a bull flag? Now this is eerily beginning to look like a bull flag here. If it does dump down here and right down to here, a lot of people will be crying that, oh, we lost all our money. But on the higher time frame, you and I, my friend, we see this to be a bull flag, and this could come here like so. If this was even like remotely like so, yeah, this would be a bull flag. Now on the monthly or on the weekly or even on the daily, try to use the bodies of the candle, not the wicks. The wicks will always lead you astray most of the times if you are looking at them on these higher time frames. Although the wicks on the higher time frames are actually bodies on lower time frames. So this right here would be bodies on the 4 hourly or even on the daily, this wick right here. Just to let you know how meaningless these wicks can be on higher time frames or even on daily time frame price action. You may be crying that, oh, it's dumping, whereas that will just be a wick on the monthly. So when you zoom out, all of this becomes clearer. When I'm thinking that, but is this thing actually going to zero? Because those thoughts must come. You must think of that because you're literally going to put in a lot of your life's worth into this. So the news will of course tell you that it's going to zero. It's really going to zero. The same like they said in 2017, 2018, this is it, we've topped out and we are going to zero. Guess what? Bitcoin rose again to 69K. And so a lot of people may have sold. But here we are. We are going back into the same thing and it's going to become more scary. So hanging tight. Now, as we were saying, this could actually, if this bounces up from here and comes back down here, they'll say, oh, well, we are down to zero. We're going to zero, but soon we will see this like we saw this down here. And we might easily break this and come right down, to be honest. I think this could even come right down to here, to this level right here. That's what I think. All of this price action can be cancelled and come down right here. So I will not be surprised if that happened. Now, bull flags, how do they look like? A bull flag is formed by an ascending, you can easily see huge price increase like we see up here. Yes, that's when you will see this. Now if you see price increase like so, where is this, like so, and you are having higher highs and higher lows and all that fun stuff. And then you see a consolidation like so. This would have been a bull flag. Okay. Now, what's actually happening here? You know, these individual candles, they join to form a pattern. That pattern will point to a certain direction. Well, the stochastics there is actually pointing to the downside. Is the market about to dump? Okay, so they all join to form a pattern which can give you a glimpse into the future of price action. So the higher highs and higher lows here, they give us, they tell us that the market is strong and we are going to the upside, but we hit a certain point here where we start coming to the downside. But the fact that bulls, now bulls are simply, say, people who have a bullish bias, who think more that price is going to go up, so they are mostly buying. Bears are, you know, people who are mostly, say, bearish. They think that price is going to go down, so they are mostly, they are always, say, shorting, I would say. They hope that price goes down. Now, so when you see this, I hope everyone is on point up till now. You're welcome. You're welcome. So when you see this right here, I hope everyone in the premium is here. Where is everyone? So when you see this right here, you see the price going down. But the very fact that it is not completely coming to the downside, it means bulls still have strength. Okay? Now, let us go to a lower time frame so that we can explain this more. On the monthly, it may not really make so much sense. We may not even see, you know, examples that we can actually relate with. So let's go to the daily here. Let's go to Chainlink. Yeah, Chainlink, because the guy who was talking about Chainlink there. Where is Binance? Now, if you are not yet on Binance or on any exchange, you may use one of my links, which I will leave in the description of this video. Yeah, I will leave the links in the description so that you can, you know, sign up to any of the exchanges. That will go a long way to support me and support the channel and support this community. Let's go here. Let's go to Bybit. But how is that not on Binance? I really don't understand. Okay, now there was a bull flag here on Chainlink. All right, now that's the same thing that we are seeing here. All right, cool. Now this is simply what we are trying to talk about there, the bull flag scenario. It's a price continuation pattern. It shows you that despite the bearish price action that you see, the market is mostly bullish. A bear flag will be the same. Let's invert this and you'll see it as a bear flag. Good. It tells you that the market is mostly bearish despite the negative, the positive action, price action that you see, because you see that price is here going to the upside. But the very fact that this is an ascending wedge, and which comes from a drop like this one, tells you that the market will still continue on its way down rather than go to the upside. Of course, there are other things that we have to use to measure and to actually know if really this is just going to go to the upside, which we are just going to talk about here right now. So as I've said, we have two types of patterns: bullish continuation patterns and bearish continuation patterns. These are mainly our two types of patterns. So they tell you if the market is going to continue to the upside or the market is going to go to the downside. Now, again, patterns are subjective, so this might really take some time, but I tell you, if you understand patterns, you will be able to make some really crazy predictions over time. Yeah, really crazy, like spooky. Okay, so here, for example, let's invert this back to its normal form. We're talking about price continuation patterns, bull and bear flags. So this is our example of a bull flag. It tells us that despite the fact that this is already going to the downside, where we are having a lower high from this one, another lower high, and another lower high. So higher highs tell us that the market is in an uptrend. That's market structure. Okay, so whenever you look at a chart, you see I'm really sorry that I'm just bringing this up as I go along, but it's a bit how my brain works. I don't know how to put everything in a line like this. My brain is a bit funny. My brain just brings up stuff as it goes along, but it's a very good way of learning. It makes it less boring, I believe. So who is there? If you have any questions, just let me know in the comments here. If you have any questions at all, just let me know as we go along. That's the good thing about having this having these live classes, that it's the good thing about it, so that you can ask your questions live. So what tells us that the market is in an uptrend? When we are having higher highs and higher lows. We talked about that in my other video. This right here is an example of an uptrend. We are having a high higher than this one. Yes, so this right here is our high. This high is higher than this one. This other high is also higher than this one. This high, even this one, is higher than this one. This one is higher than this one, and this one is also higher than this one. We have a low. This low is higher than this one. This low is higher than this one. This low is also higher than this one, and so on and so forth. So we are having higher highs, and higher lows. This tells us that the market is in an uptrend. Already I am seeing a pattern there. Yes. Already I am seeing a pattern. And this right here could also go like so. Ascending wedge to the downside. But we will talk about why it did not go to the downside and why it went up. Okay. Yes. All right. Now, simply because it had a bullish divergence there. All right, so you don't want to short this, or you don't want to bet that it's going to go to the downside. You want to bet that it's going up. It has a bullish divergence here. The stochastic here, the momentum is increasing while the price is increasing. You don't want to be caught up with something like this. Of course, we may make the mistake of shorting it, and that's just it. I'm not perfect. No one is perfect. All of this is just to help all of us know what could potentially happen, as I said before. Now, you are having higher highs and higher lows here, but here we are having lower highs and lower lows. So this low is lower than this one. So these are lower lows and lower highs. But these lower lows and lower highs come from an uptrend, a sharp uptrend. So this right here would give us a bull flag like so. And when drawing your trend lines, you want a price to touch your trend line 3 times on either side. Yes, so if it touches here 3 times and touch here only 2 times, you can confirm that, you can take that as a yes. The best will be if you have a long uptrend for that price is touching it for like 7 times. That's your best short. Okay, like that's the best thing you want to see. If the more price is consolidating in a descending or ascending wedge or channel, the more your thesis becomes valid. So that's what we are looking at here, a bull flag. Yes. All right. Now, is price going to go to the upside here? That would be the question. Yes. Is price going to go to the upside? Now, it could go. This is on the 1 hourly. This is on the 1 hourly. It could go. Why? And it's actually starting to move. Why will it go to the upside? First, well, it's a bull flag. Second, we have a wedge here. So a bull flag is say a mixture between a pole, because this is the pole, your pole of the flag, and a descending wedge. And in the other lesson, we were saying that descending wedges are bullish patterns and ascending wedges are bearish patterns. So you have the pole and the descending wedge telling you that price is going to go to the upside. We will say why price will reverse later. So we have this, we touch from here to here. As I said before, you can still just take from here straight up to here. If you want to be more accurate, take from here to here. 2 candle closes, not here, because you really don't know. This might be a bit shorter here. All right, so you want to take the 2 candle closes. That is your target. Now, so you take from here to here and you put here. All right, so this right here now is telling you that if price actually closes outside here on this 1 hour, you will find price going back up to here. Okay, you'll find price going up to here. Now, if you want to be sure, if you want to make a move here to be aggressive, you could long it here. All right, you could long this stuff here. You could come here, you put a long position here. Just example, yeah, you put a long position and you put your take profit around here. Now you could put your stop loss somewhere around here. All right, so this previous candle here, that's where you want to put your stop loss. I would put it a bit lower than this one. Yes, because we know that it may as well come to retest this level here. So you could long it here, but to be very safe and more sure, and you want to short it instead. And I will tell you why you would want to short it. You want to short it from here because you know that price can easily come up here. You'd want to play both games, but I like to stay on one side. If you want to long it and short it, you may be wrong perhaps, because if it comes down here and and goes up and you take your profits, yeah, and you want to put a short position, that will be you just playing around, and it's not sustainable to do that, except you will just want to do that all day, but I would put my short order here, put this slightly above here, yes, and I push it right down to support here. That's how I'll place this trade. Yes, I think as a matter of fact, I may actually do this. I may just do it later. So that's what I would do here. Yes, I would want to short it because I think this will be the target here. Yes, now why am I shorting it when the target of the flag itself will be up? This will be the target of the flag. The target of the flag will be from the base of the pole to the highest point of the flag, the highest close of the flag. The base of the pole, which is here, to the highest close of the flag. Why is the base of the pole not here? Why is it here? Because you have to take from this one right here. This right here is a double bottom formation. We will talk about this. This right here is a double bottom formation. So this is your double bottom. All right, that's your double bottom. Now, the double bottom has a neckline. So you want to take your pole from where price broke out of that neckline. That neckline will be from this candle close right here. So you are taking from the next candle where price breaks out of that neckline, that open of the next candle. This is it. So we take from this open right here to the highest point of the flag right here. All right, that's where you want to take your. I hope everyone is up to point. I'd like to see exceptions where it didn't happen as so. Yes, we will come to that. It may as well just happen right in front of us. Yeah. All right. So that's what we will be seeing right here. Now, let me see if yeah. All right. I don't want to put my main light on because you'll not see me, and the other one will just be too whitish in the video. So yeah, that's what we'll be seeing here. Now, if this is how you calculate your pole, this will be like so. All right, this will be like so. So you stand to lose 0.66% of your investment or of your trading capital if price actually rose right up to here. Can it go there? It can, because that's the previous supply right here. Okay, but we will talk about why it may not go there. Okay, so this will be where I would want to short this. Take profit one will be around here. I don't like take profit ones, and it does wreck me sometimes, but I don't like it. I like one take profit. Take profit one will be here, because you would want price to come up here. From here it comes up here, retraces down to here, which will be the support of this descending wedge here, then goes back up to here. In the case where it is going for the target of the bull flag, goes back up to here and goes back down to the previous, to the lowest support right down here. All right, so that would be the the price action roadmap right down here. So to be safe, you could take your profits here if it does come back up here. Of course, it may just come here and go right back, right up. There is literally no guarantee, but there is no other way to do this. You know, like that's trading. You know, you have to risk it. It's always a risk. That's it. It's always a risk. There is no. It's always a risk. That's it. All right. So that's what you would expect to happen here. That's from the bull flag. So the bull flag, the first price target will be here, following the bull flag thesis. The second price target will be here. So the first price target of a bull flag, you can note this, is the wedge, this wedge. The second price target is the pole. That's the ultimate target of a bull flag. From there, you would expect that price has elapsed its movement, so the entire momentum that was built on this bull flag, because when price comes right up here, people start to sell. That's I'm giving you now the psychology here. People start to sell, but more people are thinking that it should continue going up. All right, that's why price is not just going right down from here. It could as well go. People could be spooked and then price goes right down here. Okay, so you can anticipate that before you are taking this move right here. That's why you would put your stop loss somewhere here. Yeah, now this is on the 1 hourly. On the daily, that stop loss here will be a lot. So the higher the time frame, the higher the stop loss. All right, because if you want to put a very short stop loss on the daily or on the monthly or on the whatever higher time frame, you'll just be stopped easily. So you have to put it a bit higher like so, but on the daily or say 3-day time frame, that little movement like this will be a lot. So that's how it works. Now, so here you see that bulls are holding the price from going to the downside. That's why you are seeing these wicks here. These wicks that you see here mean that people are actually buying and putting the price back up in the wedge. Though any wick is indication of people buying, any wick to the downside indicates people buying. Any wick to the upside indicates people selling. One point we have come across. So it's the same thing here. You see people selling. Then you see here buying, here buying, here buying, here buying. So the wicks give you info on what is going to happen. Now, when you see a bull flag, what do you look at to have some sort of confirmation on what could potentially happen? You look at the volume. All right, you can look at the volume. Is the volume increasing as the price is dropping? If the volume is increasing as the price drops, that means if the selling volume if the selling volume is increasing as the price drops, it means that there are more people willing to sell as the price is dropping. So we have strong selling pressure there. In that sense, you will not even really see these wicks here. You will see full candle closes like this one here with just maybe a little wick, telling you that there are more and more people willing to sell. All right, so that's what you should be looking at. Also, you look at the stochastic RSI, or say the RSI, but I just use the stochastic. It's faster. It gives you data faster. So you look at the stochastic RSI. What's going on with it? Is it increasing as price is going down? Because that will show you that the momentum, the selling momentum, is increasing. But no, the stochastic here is dropping. So if the momentum, because this is, we have market structure going to the downside, yes, in a descending channel. The descending channel already is telling you that price could easily go to the upside because it has a bullish bias. We've said before, a descending channel has a bullish bias, an ascending channel has a bearish bias. So we have 1 point for bullish price action. We go to the stochastic. What's going on with it? Is it going up or is it going down? Because the stochastic is measuring momentum. In this case, selling momentum. If the stochastic is going to the downside, it means that that selling momentum is dropping, which means price can actually go to the upside. Right? Now, so that's what we are seeing down here. So we see from this top right here, and we see from this down right here. But then we do have a problem. We see the cross in the stochastic here. I hope you guys can see that. We see a cross in this stochastic. When the blue crosses the red, you will have some selling pressure. All right. When the red, when the blue, no, not red, yellow. Am I colorblind now? Is that even yellow? Maybe my eyes are just getting bad every day. So when, let's just call it yellow, or I don't know, brown. Is that brown? Is anyone even? All right. When the blue crosses the brown or yellow, I don't know what color that is. When the blue crosses the brown here, we know that the momentum is changing direction. All right, so when you see this cross here, like this one here, you want to see it either in the overbought. We'll talk about this a bit later. But so you see this momentum going to the downside as price is going in a bullish biased pattern, the descending wedge here. So you know that price can easily go to the upside. Again, the stochastic here is going more to the downside, showing that this selling momentum, the lower lows and lower highs, is actually shifting to the downside. So that momentum is shifting to the downside, so you'd expect price to go up. All right, so we've understood that now. I think if we invert this, can it say the same? Okay, now we can also see this in an inverted chart. Okay, in an inverted chart, I've just inverted, so this is like the opposite of the chart we were looking at before. Yes, so we see the ascending wedge here. All right, ascending wedge, what's the bias? To the downside. All right, so ascending wedge, say, and this also, you can also see this right here as a double top. In an inverted chart, we will see that as a double bottom. Okay, good. So we are getting more points for a possible price going to the upside. All right, now in the stochastic, what are we seeing? This is telling us that price will go to the downside while the price is going up. The stochastic is telling us that this price movement we are seeing to the upside is actually fake, because the momentum going to the upside is dropping. Okay, the momentum here is dropping. So in a regular chart where price is going to the upside, we are seeing this as a bullish divergence. Why? Because it has made a high here. All right, then it has made a higher high from this previous high here. Now that higher high does not correspond with a high in the stochastic. You want a higher high on price action to correspond with a high in the stochastic to confirm price momentum to the upside. But no, we have a high right here, which can be seen from the stochastic down here. But on the second high here, the stochastic is lower. So that tells us that that price action going up is fake. So price should actually reverse to the downside. Now that's on the inverted chart. So that's exactly what we'll be seeing here. That downside that we're talking about before is up here, because now is the regular chart. So we expect price to actually go up from here. All right, so that's what we'll be seeing here. Now you can also see that the stochastic is already shifting direction now. All right, it's trying to confirm our thesis. Now it's good that this is live so that you actually see it happening. It's not like I made a video and I came and I edited some stuff. So you see it actually shifting here. It wanted to go to the downside here, but no, we find it going up. So this is confirming, further confirming our price action to the upside, confirming the price continuation to the upside. All right. So that's it. Now, what else do we expect? What else do we use to further confirm this? Because we cannot just use only these two and we're like, investing everything or betting everything based on this. To know the levels that price could easily bounce off of, we go now to the Fibonacci. Okay, so this is, I'm telling you what I use here. There are a lot of other things. You can get the Gann fan, I think. I used to use that some time ago, but I stopped. It did not really make sense for me. Where is it? Yeah, the Gann fan, this one. You put like so, and you have to draw. It's just too complicated. You know, it's really crazy stuff. So I stopped that. But now I use only so these are the three things I'm using these patterns, understanding price action in the candles. I use the patterns that I see, then I use the stochastic, and I use the trend-based Fibonacci. You can also use the Fibonacci retracement for this type of price action, but using the Fibonacci, I would go for the 4 hourly. So this is just the Fibonacci retracement. This is the trend-based Fibonacci retracement. So in this situation, I would use the trend-based Fibonacci. Now, how would I use the trend-based Fibonacci? I click here. I come to the highest point here. I click there. That's 1. I come to the lowest point here. I click here. That's 2. And I come to the second highest point. Now, with trend-based Fibonacci, you use the wicks. With Fibonacci, you use the bodies. I come here. So this is the second highest here, and I click there to know my levels. Okay, so there we are. There we have it. So we see that price here. I don't know if you can see that. Let's take this out. Take this one out. Take this one out. Take this one out. Take this one out. Okay, good. Now, what are we looking at? Now we see, ladies and gentlemen, that this right here, we can see that where we are actually dancing around the 0.5. I don't know if you all can see that. Maybe I should put the color a bit, maybe I should make the background a bit. Yeah, maybe I should just put it just for a moment, and then so that we can all see what's going on. All right, so what we are seeing here is that price is consolidating between the 0.618 and the 0.5 Fibonacci retracement. All right, so I think, okay, now we can see that now the 0.618, 0.5, 0.328, this is the 0.618, this is the 0.5 right here, and this is the 0.328 Fibonacci ratio, golden ratio here. These are the 3 strongest golden ratios. Okay, that's where you want to have a strong bounce. If price leaves these levels, you want it, if it leaves it to the upside, you know it's going up. If it leaves it to the downside, you know it's going down for quite some time. Okay, so you always want to use this as your area of price consolidation, or if price is going to bounce off from any of these, you can use that as a confirmation of price upward or downward direction. Okay, so these are what you want to look out for. So price is consolidating between the 0.618 and the 0.5. Okay, when it leaves from here, and you can also notice that the 0.382 is actually just where our downward sloping trend line here. So the top of the wedge, that's our 0.382 Fib retracement. Now this is on the hourly. Yes. Okay, so far this is just consolidating here. All right, this is just consolidating, so we'll expect it to move to the upside in this scenario. Okay, so here, this is what I would do. I would come here. Where's the 1.618? Now this 1.618 should be seen as if price goes up to here. Yes, if price goes up to this this 7 point, this is chain link, this is 7.30, that will be the target of the descending wedge here. All right, if it goes up to here and retraces back down here, of course it might come down to my target of this my target here of the short. Yeah, now this target is in confluence with the neckline of this one, where it left, where it even created the bull flag in the first place. So that's the target. All right, now if I was to be very optimistic, I would expect that price eventually comes down to the 1.618 Fibonacci golden ratio. So this 1.618 is like quicksand, I would say. It's like quicksand. It's like the center where everything is, as explained by Fibonacci. It's like the center of everything. It's like where the uniformity comes in. If you look at every Fibonacci retracement, you would see it, or the pictures that you see of Fibonacci, you would see it like so. Yes, you often see it like a spiral, like so. This right here, this is the 1.618, okay, of the trend-based Fib. Okay, this is the 1.618. So everything, when it leaves from here and comes here and comes here and comes here, it eventually comes here. When it leaves from here, from the 1.618, and it goes here and it goes here and it goes here, finally it will still come back here. So this is like the ultimate zone where everything is made uniform. It's some crazy stuff. Okay. Yeah, so I would expect it to come down here finally. It will come down here, and you can actually take note of this. Yeah, just put this on some paper and put it somewhere. You will see that when Bitcoin will dump finally, because Bitcoin is controlling everything, when it finally dumps, you would find that Chainlink will come and hit this area of $6.834, and it will not just go right down. It must hit this and go back up. It's really just a crazy mystery, but this really happens all the times. You can find every chart, draw this, and you will see it happening. It's like sorcery. Yeah, you will find it happening exactly like so. It will not come here and just go right down. It will come here, hit this one, go back up. It must stay here for some time. It's funny, but you will find it doing that. So in fact, you can see the same thing happening here. I mean, you can see these, it respects all of this stuff, this golden ratios. You will see it respecting it. When it comes here and it closes below here, this closes below here, price goes down. If it closes below here, price will go down. If it closes below here, price will go down. If it closes above, price will go up until it meets the next one. So you could even scalp between these ratios. All right, you can scalp between them, but the problem is these wicks. I mean, you'll always see it do this. It will come here, hit this one, especially between the 0.382 and the 0.618. You will find it consolidating between them like so. But again, I don't like using all of this for scalping and stuff. I just like to gather the entire move. Of course, sometimes it might get me badly wrecked, but gathering the entire move can also get you extreme profits on your trades. Hello. Something Bitcoin. I'm reading one of the names in there. So yeah, that's what you want to be looking out for here. So this is what you want to see. Now, why did I think it will come up here on the top of this wedge and go to the downside? That's because of this here. If you go to the 4-hourly, is it even the 4-hourly or the daily? All right, good. It's the daily time frame. All right. But even on the 4-hourly, you can still see it happening. On the 4-hourly, we can see that it's on the move to the downside, which means we can still have a bit of price action to the upside before downside. Yes. Now, this upside target here, as you can see on this 4-hourly, is the previous close right here. All right. And yeah, the best will be here. The best will be here. So if I was to take the entire move, if I was to capture this entire move to the downside, if I was to short it right to the downside, my stop loss will not be here. my stop loss will be somewhere up here. All right, now that will mean because if I was to take it here, if I was to take it right at the neck right here, if I was to take it here, I don't know if you're seeing, if this is really too far. Okay, if I was to take the move from here, all right, I may miss out because price could come up here and turn around here, then go to the downside, and I've missed out on the entire thing. All right, so I would make my entry here. I would make my entry. By the way, if you don't know how to place short or long positions, I have a video for that in the channel. You can see how to trade futures there. You can follow the same rules in the video and place your trades same like so. I have a lot of people who are already doing that. So if I was to take this move here, I risk missing on the entire move to the downside because I was trying to not be in the red. Okay, that's why, yeah, swing trading can be dangerous. It can make you capture entire moves to the downside and you get humongous profits. It can also get you wrecked because if you took this as your entry here, which is the target of the descending wedge here, all right, and the price comes up here and reverses, you made it. All right, if the price comes up there, you will be in the red on a 2%. Yes, 2.17%. So this 2.17% will be on a 15x. You will be on a 32% loss. Okay, 32.55% loss to be exact. Okay, that's, yeah, on 2.17%. You'll be on a 32.5% loss. But let's say it went up here and took you out here, and took you out here at a 3.55. So you're losing 53.25% here. All right, but your mission is to capture the entire move to the downside like so. Where is the move to the downside? The entire move will come right down to here, to the previous this previous neckline here. This will be your entire move. Yes, so you want to capture this entire move like so, and you are risking 53.25% of your portfolio, of your entry capital here to capture this entire move. So that's why it is through swing trading can also, that's how it can also be risky, because it makes you have a wider stop loss. Yeah, if this was a scalp, you won't want to capture all of this, so your stop loss will also be very small. The more you want to capture, the more you stand to risk. So that's how it works. It's not always on one side. You have to risk more to get more. That's just the rule of the game, yeah. And it may as well just go up. It may as well just go up, and even go up and show you a bearish divergence here, which will make you to increase your stop loss to a wider angle like so, like 9% or even more, because you know that, and the moment you can decide here and close, and it reverses just above here. So it's a lot, Anyway, so that's the thing here. Now on this 4 hourly, we see that the stochastic is actually going to the downside. Let's just erase all of this so that we are all on point. On this 4 hourly, so the bull flag we are seeing on the 1 hourly, you can see how it's actually performing here. We can see that this is a bullish engulfing pattern here. Yes, we can see a bullish engulfing pattern, and if we see a green candle forming here, as I said before, a green candle filling the wick of this other green candle here, then we have price action going to the upside. The other time in my other video, I was telling you that in the first 2 hours of a 4-hourly candle, you will mostly see bearish price action if it is to be a bullish candle. If it is to be a bullish candle, in the first 2 hours, don't expect price to go to the upside. In the first, say, 20 to 30 minutes, it could go up. That's what we saw here. And then it goes down for the rest 1.5 hour. So 1 hour, 30 minutes. You will have it going to the downside. And on the next about the next 40 minutes into the next 2 hours, you will have it consolidating here, and say the last hour you have it going to the upside. This is what you could just know. And if it finally closes up here, then you have a confirmation of this bullish engulfing pattern. Yes. Now, if the next one comes in and we have a consolidation, and that consolidation results in, say, a doji around here, I would be selling, because that is telling you that there is indecision of this pole here, if price is going to go for the target of this pole. I hope everyone is understanding up till now. Yeah, swing trades can be they can be extremely profitable. Yeah, they can be extremely profitable, and it really, all of this depends on you, you know. It depends all on you. If you can handle the tension, you know, because, or perhaps you don't really even have, you don't have the time to sit all day and you know, be on the charts. If you're a day trader, you have to be there and you're watching the price, and you want to make a move when all of that. If you don't have the time for that, you have to just do swing trading. If you have the time, well, you can go for scalping, you know. But if you do not have the time, you have to go for swing or position trading. Yeah, you capture an entire move to the upside. You don't just go there for 1 minute or 2 minutes or 5 minutes. You capture an entire move. You place a trade and go about your day doing what you want to do. And perhaps you could just browse, you know, sometime and watch price action or anything. And this last minutes here, we would have price actually trying to go right down here, trying to stop out anyone who was here. All right. So if you were to long here, this is when the tension will come, because price here now will come right here. So if I was to place a long position here, I would actually be waiting for this right now. I'll be waiting. That's if I am trying to scalp. I'll be waiting for price action here on the last minute of the second hour on the 4-hourly candle. That's what I'll be doing. Now, I'm mostly only long on these higher time frames. The minute and the 5 minute, those are just too small for me to comprehend, I would say. They're just too small. So yeah, so basically that's what we see happening here, and that's how you can trade with these bull flags. Of course, they happen the same for bear flags, and you would also see something that looks like so, like this bull flag. Now, before I go now to pennants, just before I go for pennants, you see this here on the daily time frame. Okay, this is the daily time frame for Link. Now, we've had price have a bull flag here, a bullish engulfing here. We had a confirmation for the bullish engulfing. We had another confirmation, and then we had price going to the upside. Yes. Now, this inverted hammer here tells us that price is going to go to the upside, but then the stochastic is in the overbought region. So what's going to happen? You know that it's overbought, it has to come down. But that's on the daily time frame. So on the daily time frame, you know that price is going to come to the downside. But on the lower time frame, that lower time frame is where people are going to get tricked. People are going to get tricked into thinking that it's just going to go ballistic. It's just going to go up. Yes, but the daily is already telling you that institutional traders, they are already on their way to sell. So you have to be much more careful there. All right. So here now, you are getting ready to sell. or you are getting ready to short. All right. Of course, it can just go up. There is no guarantee. Yeah, there is really no guarantee here. Yeah, there is no guarantee. Of course, it can just go up, but it may not. You know that this being here and you have had this cross here, there is a very high chance it will go to the downside. Now, for you to be a bit more confident of it going to the downside, you will want these lines here to be in this blue region down here. You want this cross to happen and it come right down into this region right down here. So you know there that it has a higher chance of coming to the downside. It being overbought is no guarantee of a price drop. There's no guarantee. There is no guarantee anywhere. You know, there's no guarantee. All that we are doing is just to increase your certainty of price going up or down. That's all we're doing. You know, that's what makes this different from gambling. Gambling, you will just wait and hope on luck, you know. But this you have some metrics to follow. You have rules to follow. You have some things that make you think it's going to go up, and majority of the times it will obey what you think will happen. That's what makes this different from gambling, and that's what makes this sustainable. Okay, you will win, you will lose, but you have to win more. That's why you are still here. Yeah, that's why I'm still here. I've lost in many trades. It's not like I always win. Some people tell me, oh, bro, your predictions are 95% accurate. That's because they are longer term predictions. You know, I can predict something and it happens next year. And of course, I would have predicted it, but it was a longer term prediction. If I was to trade based on that prediction, I would need to have a very wide stop loss, very wide. In fact, I wouldn't even be thinking of stop loss at that point, because I'll be thinking more of liquidation point, not stop loss. Because trading, let's say I want to short Bitcoin to 3K, my stop loss will need to be somewhere around 23K. Yeah. So yeah, that's just the way it is, you know, because it can easily go to 18K, it can easily go to 19K. But if it's crossing 23K by my chart thesis, of course, it's getting back into something extremely bullish. So it means it from there it can go to 30. From 30 it can go to 33. So my stop loss in that, my liquidation point, needs to be higher. But where I need a mental stop loss. I need a level where I think, oh, perhaps here it may not continue to, it may continue to go way higher. So that's where I have my psychological stop loss. You know, so yeah, that's basically it. Now on the daily here, as we're saying, it will come to the downside, but we know that it being here does not mean that it will really go lower, of course, because it can stay here for a very long time, just like it stayed down here for some time. All right, because when it comes right down here, you could say that, oh, it's undervalued, so it may just go up. No, it may not. It may stay down here while price continues to come down. It may stay up here while price continues to go up. All right. So with all of this, you get to, you know, choose your risk wisely, I would say. So yeah, that's for bull flags. That's how you measure bull flags, and that's what bull flags mean. That's how you can use bull flags in your analysis. Use the bull flag, use the stochastic RSI, use the trend-based Fibonacci to know where price can bounce from or where price can go with a maybe higher degree of certainty. Okay. If we were to use now, even here, you can even expand the whole chart and you will see that this is just part of a bear flag. All right. Yeah, all of this that we've been discussing is just part of, we are inside of a consolidation, and that consolidation constitutes a bear flag. because we are here somewhere around here. We were talking about that on the 4-hourly. That was right here. The overall supply of this price action is way up here at $9. So even that stop loss which I was talking about earlier, which would have been like 3%, that will take me out if this was to come right up to here at $9. But will that come up here at $9 when the stochastic is overbought here? Not really. You see, not really, because if you even go to Bitcoin, you will see that Bitcoin is also in the overvalued, and it will take a lot of buying pressure to push this price right up by 33%. It's possible, very possible, but it will take a lot. So that you also have to factor in. If you want to wait until it comes up here before you short it, or if you want to wait before it comes down here before you long it so that it goes up here, that will take you a very long time. So you have to go right into the price action, then you take your risks from there. Okay, so yeah, so that's basically what we are seeing going on here. Now let's go to bull pennants. Bull pennants are also price continuation patterns. Bull pennants and bear pennants. Bull flags and bear flags, they are just the same, like bull pennants and bear pennants. But bull pennants or bear pennants, for me, it works pretty good so far. Cool. Watching the 5-minute up to the 4-hourly. Okay. I made today 9 trades and cashed in on 4 if them, and I did scalp on 5 minutes. What I was watching is volume, support, resistance levels, RSI and MACD. Cool. MACD is slower, even the RSI is slower, but it's really working well because you are doing it on a very low time frame, so it's faster there. If you were to use the MACD on the daily, it will be very slow. You have to use something that's faster. Now, it's slow, but it will give you a more accurate value, okay? But I would use the stochastic with it because it gives you a glimpse. You know, it whispers into your ear what is going to happen potentially. So I don't just go for very, very slow indicators. You know, yeah, but my chart will mostly look like this, and I base a lot of my analysis on trend lines. All right, I base a lot of them on trend lines, not just for this. All right, so this, we can see a bull pennant is price increase like this, consolidation like this in a trend line, in a straight line. Let me put that well. Is there anywhere here where we can find a bull pennant? Let's go to like the 30-minute. We'll see, maybe we can find a bull pennant there. A bull pennant. That looks like a bull pennant there. No, it's a bull flag. So bull pennant, I've made the video about bull and bear pennants here on YouTube. You can check them out. I have a video on bull and bear pennant, and I was yeah, I had a video about that. Let's see if there is any bull pennant here that we can spot so that we will talk based on it. This is a bear flag here. Bull pennant. Yes, this is a bull pennant that broke to the downside. So it will not really be the best example, but we can just use it so that we explain why it broke to the downside. All right, so this is a bull pennant here. Bull pennant, so you would see it like so. Yes, perhaps we use the week. We're on the 30-minute, so we use the weeks. I don't like using the weeks. They can easily just deceive you, you know. So, but let's use it and see. So we see that price already broke out of the bull pennant like so. So your bull pennant will look somewhat like so. You would have price increase like so, and this like so. Price increase and a consolidation, twisting into this point right here, where you can measure this like so, and like so. So that's a standard bull pennant. Okay, and it's also a price continuation to the upside. If you invert it, it will be a price continuation to the downside. Okay, but you will easily see a bull pennant issue a fake move, especially on higher time frames. So you will see a bull pennant like so. This is telling us that majority of the markets think that the market should just continue dumping, because we are seeing lower lows and lower highs here. But we come and consolidate into this pennant, this symmetrical triangle. So bull pennant is a mixture of a symmetrical triangle and a pole. That pole is lower highs and lower lows, and bull flags is bear flags is a continuation, price continuation to the downside, which is a mixture of an ascending wedge. So that is like so, ascending wedge, yes, ascending wedge, and a pole still. So price is ascending like so. This is bear pennant, this is bull pennant. Yes, so where is the final target of this bear pennant? The final target of this bear pennant is this pole. The final target of the bear flag, the final target of this bear flag is this pole, and the final target of this bear pennant is this pole. Now, if you want to measure where the price will hit first in the bear pennant, you will have to take the distance from here and put where price will break to the downside here. Yes, it's also here. You take the measurement from here, I like doing it like so, and put where price breaks to the downside here. Now, this is something you have to note. In every ascending wedge, the target for that wedge is the bottom of the wedge. I think I said this before here on the channel. So that's the target for the wedge. So you expect price to break from here like so and come down to this zone here, and from here break like so and come down to this zone here. Now you could also put this, and this is where the difference comes between the bear pennant and bear flag. It will come down to this zone here, which is the bottom of the pennant. You see, bottom of the ascending wedge here. But this will have a stronger target, which is the widest part of the symmetrical triangle, like so. All right, then if price breaks this level here, if price breaks this level, and also breaks this level here and closes down here, know that that is a confirmation of the pole and this pole. So it will then continue going to the downside like so. So even if it breaks it, and we will make an example of this on Bitcoin, even if it breaks it here and breaks it here, you want it to have a confirmation of that breakdown here. So a confirmation will be another candle that is probably filling the wick of the red candle that may have broken down from here. Yeah, so you want it to break, and not only break, but you want it to close below here. For you to fully confirm this, you want a close and another candle confirming that close. Of course, the risk comes in, because you may be waiting for that close like I did on FTT, and it dumps massively. You don't get any chance to enter. It dumped, FTT did dump from, and I wanted to enter at $22. I wanted to make a signal at $22, and I was like, oh no, I should wait for the close. I woke up the next day and the close was already at $13. So yeah, so I missed out on a lot of gains because I was waiting for a close. That is why on swing trading, you may not get what you are looking for. The idea of getting a good entry may not be there. You may not get that. You may not get that opportunity of having a good entry. All right, so that's basically what we will be looking out for here. Now so that's for bull and bear pennant. So if you invert it like so, you will also see the same thing going on here. This is the bear pennant, this is the bull pennant, this will be the bull flag. The same thing to the upside. Break from here, comes up here to this target here, and you know that it will most likely go up for the target of the symmetrical triangle here, which will be up here. If you wanted to short this, on a swing, you will enter here. You will not wait to enter here because it can reverse here and go down. If it reverses here, it will give you a double top. Your double top will be like so. It will give you a double top here and go down. So you want to enter here, but put your stop loss above here, because if you put your stop loss here because you think, oh, let me be conservative with my stop loss, it will take you out and come for this target. You'd have just lost for nothing. Swings are risky because they make you put in higher stop losses, wider stop losses. On a scalp, well, you'll put your stop loss here because you're just ready to lose just a tiny bit of your trading capital. So, but on a swing, you want to capture the entire move. If you are waiting for this, it may dump here and you miss out on it. You find yourself rushing to enter here. If you rush and enter here, you will still have to put your stop loss up here, which will just give you more of your portfolio to lose. So you enter here and you are waiting to capture the entire move. That's on a swing. All right, but if you want to be, more capital conservative, you don't want to risk a lot, you will have to wait until here, and waiting until here will mean that you will miss out on a lot of trades. So it is what it is, but that's just the risk you will have to take. That's just it. All right, but of course you can use more confluences. Like here, you use more confluences. You know that price did bounce up from here some time ago, so that gives you a confluence that entering here for your swing down to here is just more risky, because you know that price did break right up to here. We had this, and easily that we will come up to this supply here. You see this here, this will be like your supply zone. This here, you know that price can easily bounce, come up to this level here because it came there before some time ago. So there is a very high chance it comes up here. That is if we find this kind of movement up to here. Then here, if you are entering here, then your stop loss now will be smaller. Your stop loss could be somewhere around here. Why is it somewhere around here? Because that will be 50% of this candle. I was talking about this the other time. 50% of this other candle here. All right, so that will be the entry movement there. You're also doing that with reference to your stochastic. You are looking at your stochastic. If your stochastic is in the overbought and you are seeing price up here, that is a for sure entry. All right, but if your stochastic is in the undervalued and you're seeing it here, know that price will validate the pole here. There is no need taking that risk. All right, there is no need taking that risk. If price goes for the target of the of a bull flag like so, and you are seeing the stochastic on the undervalued, showing that it's still starting to go up, don't even take that risk, because it will go up and take you out. All right, let's see if this thing is even performing better from when we left it there. If we had taken the trade we were talking about, where is it? All right, we have a bearish engulfing pattern on the 1 hourly here. Let's look at the 4 hourly. We were talking about the 4 hourly. The 4 hourly, yeah. So this now is beginning to look like the second phase. Yeah. So we're talking about 4 hours. 4 hours here. So we're talking about 4 hours, and we said on the second 2 hours we want a correction mostly to the upside. But if it does closes this after this, if it closes down here, then we know that it's validating this one right here. So this bullish engulfing pattern tried to cancel this bearish engulfing here. But if this closes down here, we know that this is mostly bearish and it will just come down here. It will be validating what we are seeing on the daily, the overbought stochastic here. Of course, I said patterns are a bit more troublesome. So if on your higher time frames, when your higher time frames are bearish, you have to be mostly bearish. If your higher time frames are bullish, you have to be mostly bullish, because the trend, the trend itself will not be on your side if the higher time frames are bearish and you are being bullish on the lower time frames. Except you are really on the lower, like maybe 5 minute or 15-30 minute. All right, so that's what we'll be seeing here. Let's go for a little break, and I will talk with some people in the Discord group, and we'll restart this in about 10 minutes. All right.